It's not a normal season, is it?
No, it's not. And yeah, their earnings are going to be up like 20%, but last year was a really bad year. The second quarter, JP Morgan had $4 billion in losses on the whale trade. Bank of America had more than $20 billion in mortgage losses. And so you had a very unusual bad quarter for them last year that they're coming off of. So their earnings are going to look good anyway.
But are we going to see, like the Wall Street Journal had from Keith Bruyette yesterday, a 10 or 12 or $4 billion hit to the balance sheet?
Yeah, we might. We might on certain portfolios. Commercial loans, commercial and industrial loans are going to take a very large hit, and the reason being is that those loans are funded on short-term duration, funding devices, and the Fed is keeping interest rates really low on that. So their net interest margins on those types of loans and securities are down a lot. Plus, you've got the bond prices tanked this last quarter, and so that's going to hit them on a mark-to-market basis in their available-for-sale portfolios.
And that's the part that I want to get at, this net interest margin being thinner and thinner every quarter.
Yes.
That's what they keep saying every quarter.
Yeah.
And yet, when you have rising bond yields, you would think that would help them.
It's because a lot of the assets on their books are funded on shorter duration, and also they've got all these 30-year mortgages. Who's going to refinance a 3.5% mortgage when rates are now over 4%? So that increases the duration of their very low-yielding, very poor-paying mortgages. So no one's going to refi. Those are going to be on the balance sheet for a long time, but they're getting, getting less money on the commercial loan.
Within this complexity, we've got Neil Barofsky, Bloomberg contributing editor, and he had a book, I'm going to say 2 years ago, the movie's out Memorial Day of 2016. It is Bailout. We knew this was coming. At some point, bond prices go down, and am I right? This is new. These guys really take a hit.
Look, I mean, what Uncle Sam giveth, Uncle Sam taketh away. Or really, probably Uncle Ben is probably the better answer.
Yeah.
So you have this massive distortion in the markets caused by the government, which was, the policy was to recapitalize the banks by creating profitable opportunities for them through interest rates, through other types of programs. Sooner or later, that was going to taper off, to use the word of the day, taper. And that's what's happening right now. This is not like the government striking at the heart of the banking industry. This is the beginning of a return to normalcy, and these supercharged profits that were generated from government policy are going to wane a little bit.
Do you invest, Jason Trennert, in banks knowing they are supercharged profits?
Listen, I think I am interested in banks on the positive side, and I would say one of the things that's going to happen as a result of what Dawn is talking about, in my view, is that banks actually might start to make loans. There's a compression of net interest margins.
Talk that they're going to not pay out dividends and not buy back shares.
Yeah, but I think, and this is a key issue for the overall economy, though, because the Fed has been literally dumping money out of helicopters, but it's been going directly into bank vaults. The velocity of money has collapsed. So there's been no multiplier. If banks actually start to make loans, all of that changes. And then a lot of the questions that we've had that people seem passé now about inflation, about all these other things can start to come to fruition. But that, to me, could be the positive result of some of these pressures that we're talking about
also
right now.
Basel. We can't forget about the Basel rules, capital rules going into effect starting next year.
It's not just Basel now, with U.S. regulators pushing for even higher capital equity
Well, because they've adopted the Basel, which starts in 2014, but then there's this leverage ratio that goes into effect, over the next several years. And so even though the leverage ratio doesn't go into effect until around 2018, banks are going to have to hoard cash.
I just want to bring in one thing, because Larry Fink of BlackRock talked a lot about this yesterday on Bloomberg Television, and he was suggesting unintended or intended consequence of regulation is sapping the liquidity out of these markets for these market makers of the banks, exacerbating the problems for these rising interest rates, which is what your story is about.
You're getting red in the face over here.
No, I mean, I don't think we have a real danger of a liquidity problem. I think that, look, the fact that banks are going to have to hold more capital is a very, very good thing. I think these numbers, including the leverage ratio of 5% is probably way too low compared to what's necessary in order to protect us as taxpayers. And I think that the impact of it is going to be minimal. I mean, every time there's anything that it makes inroads into banks' ability to monetize their too big to fail status, we hear cries of the sky is going to fall, yet it never really seems to fall that much.
Listen, I believe in the concept of too big to fail, which say, I think you have to rein that in. By the same token, only 30% of the rules that have to be written for Dodd-Frank Frank, have actually been completed. 70% of them are still yet to be written. That is a problem. That hampers the credit creation process. There's no two ways about it.
I want to be sure we get this in. Dawn Kopeki, what are we going to see tomorrow?
We're going to see really hot headline numbers that probably mean nothing. We're going to see a big boost in earnings for JP Morgan. Wells Fargo is projected to go up by 9%, but those numbers are probably not going to mean anything. You might see a pop in stock prices initially when investors see those initial numbers, but then you might see them settle back down as they have time to digest that.
And we always hear from Jamie Dimon, of course, on the call, or we often do. So what are you hoping to hear from him?
Well, he has already guided the market saying that trading is going to be up more than 50% over last year because they had such a blockbuster April and early May. So trading's going to be strong. Mortgage fee revenue is going to be down. Jamie's going to probably give some words of wisdom on how this is all affecting the markets. Investors are going to eat that up. And so it will be the first quarter really where Jamie doesn't necessarily need to talk about the whale loss in a very long time.
And banks as a group, 20% profit growth is what Sara was mentioning. Jason Trennert, is that sustainable beyond this one quarter?
Well, I think it is again though. But I think banks are going to have to take more risks. The irony is they're going to have to take more risks in order to do that. They're not, and I know this is precisely what we don't want them to do. But I do think the idea of just playing the yield curve, I think it's clear that that's largely over.
Look, if the risk is making more loans, I think that's something that we do want to have, and that's the type of risk that we could deal with. If it's making multi-$100 billion bets on synthetic credit derivatives over in London, that one not so much.
Fair.
I was stunned this week at the consolidation of big banks. Since you wrote Bailout, we've become more consolidated, haven't we?
I mean, we're on that glide path because of the incredible advantages of having that moniker of being too big to fail and the implicit government guarantee and the lowering of borrowing costs that come with it. All the incentives are still in place to get bigger.